Hi, this is Pete Birchler of StockMarketAlchemy.com. It is Thursday, November 7th. U.S. markets just closed a few minutes ago. I have some commentary on the charts today of the stock indexes and some comments on the sentiment of the market here. Some potential ideas as far as trading this market or what to look for over the near term. The chart I'm going to show today, this is the Dow ETF, the Diamonds, DIA. And this is a daily chart. So going back, we can scroll out here, going back a couple years. And obviously new all-time highs made over the last couple of days in the Dow. This morning we saw a gap up in the Dow of part of 1%, and then a pretty significant sell-off through the rest of the day. So after price broke this September high here, we now have this failed breakout with a bearish candlestick pattern. So this is called a bearish engulfing pattern. If you look at this large red candlestick completely engulfing or swallowing up this white candlestick the preceding day, and that's a potential top reverse candlestick in the markets. If you go back, you can look and see those type of patterns. Somewhat similar pattern here at the May high in the markets, and if you study a lot of charts, you'll see that that's a relatively frequent type of pattern here. Now, these patterns may or may not always be significant, and one way to filter through what's significant or what is not can be to use some type of a technical analysis filter. So something to the effect of we only pay attention to these signals when the market is, say, overbought, or we have some type of divergence pattern in the market. So you can apply some type of technical filter to that pattern in order to see if it's really falling at a extreme in the potential price range as well. So if we just look at simply the MACD on this chart down here, we can see that the MACD line is in the upper end of its range for the last few months. But scrolling back out, we can see that MACD has gotten higher than that. There is no bearish divergence pattern really over the last few months here on the daily chart. We see the MACD is pushed a little bit above its September high. However, over the shorter term, if we just let's just go down to a 4-hour chart here on the Dow, we can see that at the end of this push up since October, over about the last month, there is a bearish divergence pattern in that price has pushed higher over the last week, yet we've seen the MACD make a lower high. So there is a relatively classic looking bearish divergence between price and the indicator down here. So just on a short term basis, I do think there's some rationale for even potentially looking at some type of a inverse or shorting trade on the Dow, or at least protecting profits or exiting some of long positions in the market. So with that being said, I want to point out an idea of how to trade this. Given the fact that this is an established uptrend, we're at new all-time highs. This, shorting here is clearly a counter trend play, and it's one that may not be a high probability play. We're going against the major trend of the market. So, how do you deal with that situation? Well, one way you can deal with that situation is to have partial profit targets and exit points built into the trade. So, one way that you can do this is here we have our reversal pattern. You could enter on a break of today's low with a stop above yesterday's high, and we're basically suggesting that this is a significant high with this reversal pattern. And then you set your initial profit target. So let's say we have from 155.70ish to 157.80ish, so we have about $2.10 risk on the trade. So you could set a 1-to-1 profit target on the trade. So $2.10 would be 153.60ish, down in this range here. So if we see the market fall to this level, we exit half of the trade, and we just leave the stop loss on the other half of the trade up here, so it essentially creates a break-even trade. We've exited part of the trade at a 1-to-1 risk-to-reward ratio, and then we can have some type of stop movement or trailing mechanism in order to follow the market down in the event that we do get a significant correction in the market. So that's one idea, a very, very simple way to trade in a way that I've used myself quite a number of times. Another way to do that is to apply the same logic, but make the initial profit target a little bit smaller. So in this case, let's again say that our risk is from 155.70 up to 157.80, so about $2.10 risk on the trade, is we set the initial profit target to be half of the initial risk. So in this case, let's say $1.05. So that would take us down to 154.65ish. So down into this range here. All right. So we can exit with a limit order. Again, half the position at this level, but then in this case we would decrease our stop limit by half as well. So once that profit target is hit down to here, then instead of maintaining the rest of the position with a stop above this high, we would cut that stop risk in half and move it down to, or in this case, 156.75ish, somewhere up in this level. And so that again creates a break-even scenario, but it doesn't require the market to make as significant of a move. And given the situation here that we have an uptrend and we have this relatively wide range reversal pattern here, this may be a more sensible play here. Let the market potentially come down and just undercut this last swing low, which from a charting standpoint is a relatively common occurrence for the market to come and kind of run the nearest stop level before a potential reversal. So given that this level here is just below that, it's very conceivable we see the market run down and at least take out this swing low before moving higher. And so if this is not a significant high in the markets, we will get our half position filled here, we'll move our stop, and essentially we'll get out with a break-even, no profit trade, but we had the potential to make a significant profit on it. Now, in the event that, let's say we do get taken out with our half profit target, our stop is moved to this level, we see the market make a mild rebound and then break down hard, then we are in a position where we can, again, trail the stop down and actually make a significant profit into the trade. So those are a couple of specific ideas as far as how to trade this market. As far as chart support levels, if we just use the Dow on this chart, we have some unfilled gaps in this uptrend. So we have an unfilled gap up from October 24th, so right down in this level at around 153.80ish. We also have a relatively large unfilled gap here from October 16th. So that would be down at this level here, about 151.30ish. Then obviously you see we have this large gap up here from October 10th as well. So those are some chart levels as well, as far as objective points on the chart where we have some unfilled gaps that may attract prices on a decline. The way I like to use those first is just mentally to understand that those may be support areas for the market, and also to use them as profit targets. So if we see the market coming down to this level here and we want to have a type of scenario where we are going to exit part of the trade, in this case if we're shorting and we want to buy back when the market's weak, we could buy back at the gap level. Again, if the market continues down, we could buy back at the gap level. Or you could, progressively scale out of a trade in that fashion. So those are some ideas on how to trade this market here. Now I'm going to move over to a chart showing some put to call ratios and the VIX here. First off, when we're looking to trade counter to the dominant trend in a market, we want to be looking for divergence type of patterns to take effect typically before we make a counter trend trade. So in this case, we're in a bull market, market's hitting new all-time highs. We typically don't want to just try and short off of a high in an indicator. We want to see the market get euphoric, see highs in all the indicators, see a pullback, and then see new highs in the market, but with lower indicator highs and with even lower sentiment peaks, or a lesser amount of complacency or euphoria in the market. And so a couple ways to do that are to look at volatility ratios and put-to-call ratios. So this is just a chart of the VIX with some different Bollinger Band configurations here. Point being that while the stock market if we move back to the S&P 500, if we compare to the August high in the S&P 500, we've seen a couple distinct higher highs in stocks, yet the VIX bottomed here in August, and in September and here in October, we've seen higher lows in the VIX. So there's not the VIX is not confirming the direction of the market. And then we also have on a shorter time frame between October 18th, where the VIX made its low right there, even though we've seen higher highs in stocks since the 18th. So the 18th was back here. We've seen the market push higher even into today. Yet we've seen the VIX not make a lower low. So there's again another level of non-confirmation on a shorter time frame. So because of the shorter time frame, 4-hour chart price divergence, and some of these daily time frame sentiment divergences, in this case in the VIX, I do think that there is some potential rationale for profit taking or establishing some initial short positions in a market here, but understand that this top picking can be a low probability type of strategy in the market. So we want to have some initial profit targets in order to help us get our risk out of that trade as quickly as possible. Then if the market does continue in your favor, you can look to short into rebounds to lower tops in the market to try and continue to trade with the trend if the trend does indeed turn down. This next chart we're going to look at is the chart of the total put to call ratio. Basically the same logic here as applied to the VIX. The put to call ratio will go low as the market rises, and the put to call ratio will spike as the market falls. So when this rises, that's an evidence of fear in the market, which typically will be happening with stocks declining. So same basic idea here. We saw the trough in the put to call ratio in September prior to the September highs, and then despite stocks pushing higher into October, we've seen the put to call ratio make a higher low. And then again, the put-to-call ratio made its trough on this push higher over the last month on October 24th, which was right here. And so despite a couple weeks of relatively higher highs in stocks, we have not seen the put-to-call ratio make lower lows. So it's trailing higher, and these are the type of divergences that you see at the end of moves in stocks that end up leading to corrections of at least a moderate degree in the market. So taking these things together, I do think there's risk of some continuation of this pullback, at least over the short term, even potentially over the intermediate term. If you look at the market just from a long-term perspective, with it being at new all-time highs and being in what is typically the seasonally strong time from November to April, we may want to lean towards the bullish side of the market here and be relatively willing to look for buying opportunities after a moderate correction and even some short-term extremes in the market, looking at hourly charts or 2 or 4 hour charts of the stock indexes. So that would be my take on what to look for. And let's briefly go back to the indexes here for a minute and point out the weekly MACD level on the charts. And I had pointed out in a recent video that while stocks were at a new all-time high, the MACD level has not been at a higher high. And we saw that happen here between May and August, where in August we saw higher highs. In May we saw, we saw slightly lower highs in the MACD. We saw a very modest correction, and then this push to higher highs basically erased the typical classic divergence pattern in the MACD. However, here we're again at a higher level. The MACD is still at a lower high relative to these levels. So to some extent, we still do have a large-scale divergence pattern in the stock indexes. It's not a real classic-looking double peak divergence, but there is a divergence present. So I do think that's potentially significant, though the more classic patterns are ones that look kind of like this at bottoms and this at tops, where we have successive peaks, and then that is the final high in the market, rather than kind of drawn out multiple peaks in a market with multiple lower highs. I tend to view this type of thing more likely as a relative sideways consolidation type of action in the markets, as opposed to your typical topping action in the markets. But time will tell what happens on this. What we need to do as traders or investors is just pay attention to the signals, and then have objective and logical ways to try and take calculated risks in the market, whether that be with the trend or against the trend here. So that is all for today's update. If there are any further comments or questions about the market specifically, please go ahead and leave a comment here on YouTube, or leave a comment at stockmarketalchemy.blogspot.com. You can get in touch with me there as well. That's all for today. All the best to your trading.